Morning, Paul. How are you?
Well, it's good to see you again. We are recording this on Wednesday morning. And of course, the big news last night was Treasurer Jim Chalmers bringing down the budget. Anything of major import as far as you're concerned, Will, from the budget?
Yeah, look, I'll say my piece, but I'm always really interested to hear what your thoughts were. But look, as is often the case, a large part of the big measures were kind of announced early with the tax cuts. So I guess that's the biggest component of the support or the stimulus or of the packages policy that we're seeing from this budget. But I guess there are always incremental positives around us. And so look, I guess as we stand back, what we had was a budget surplus, $9.5 billion, around about 0.3% of GDP. And look, a surplus is, a real positive given where we've come from and putting us in comparison to other parts of the world that are running deficits. Look, there is an expectation that next year we will move back to deficit. But again, that's based off very conservative commodity assumptions. And we're a bit more positive on the commodity exposures. But look, largely, it is a stimulatory budget. It is supportive of continued spending. Perhaps the surprise in there was the incremental news around the energy bill relief that will be brought forward again. That wasn't announced prior. And look, that's positive for lower to middle income, which has been a real trend for Jim Chalmers and the government around where they're targeting support. So look, there's a bit of spending in there. There's usual commentary around a bit of healthcare, some spending in defence, which should be positive for contractors. And then there's usual infrastructure budgets. But again, look, the real issue here is how do we get it all built? So there's a bit in there for education and training as well.
Yeah, quite a bit of support as well for the green transition. So we'll have to see how that plays out. Obviously, the support for the future made in Australia. Again, it'll take time to work through the details there.
Yeah.
The $300 energy rebate is potentially a measure designed to reduce the measured inflation down the track, which is I suppose a clever technique of keeping down inflation at a time when there's obviously a lot of interest in getting that back to the RBA's range of 2 to 3%. So that's interesting. It's worth commenting that John Abernathy studies the budget very closely, and he'll either be writing or presenting to clients either through a special edition of The View or perhaps a letter to clients setting out his interpretation of some of the consequences. But in terms of specific companies either being big winners or losers, I don't think there's much there, Will, do you?
Look, it's at the margin, and then it comes to positioning around the market. Certainly, we've seen some weaker performance from the consumer discretionary names of late as spending has come off that peak. This should be supportive. So we have the immediate tax write-off, which is what we had last year for small business. That has traditionally been positive for big box retailers and car dealers, so JB Hi-Fi, AP Eagers. And if we're looking at the green energy, which you rightly pointed out, there's some significant stimulus and support for mining companies who are exposed to lithium and other green energy materials. That stimulus or support, the subsidies kick in when production starts to be done. So we think it's positive for the Australian economy. We think commodities, we do have a competitive advantage there. But we have recently talked about our positive view on the mining service names, those that are out there to build and dig the ore out of the ground. And certainly these measures will be positive for them. So that's Monadelphous, NRW, Worley, as well as these projects come up. So we think there'll be continued activity in CapEx budget. So look, commodities we remain positive on, but look, there's expenditure here that will support that. As I look down my list, which I am, housing, there's a shortage of housing, but there's also a shortage of labour and materials to complete that. So there are some incentives around visas that are more targeted for people who work in construction and such. That should help the shortages that we have there, hopefully deflationary in a way, but also help, sort out the rental crisis that we've currently got at the moment as well. So housing construction, those related to that should continue to find support as well. And yeah, they're the areas really. So we've got contractors, housing, and mining related or expenditure, those that are building and servicing that area, which are the positive indicators.
Yeah, I'd just like to drill down into the commodity space a little bit further, because over the last couple of weeks, China's announced slightly stronger import and export numbers. So it seems like the economy is commencing a better recovery than we had seen earlier on in the year. And the one commodity that's been standing out and getting a lot of attention is copper. Obviously, copper was the driving force, I think, behind BHP's bid for Anglo American. And I noticed that the Wall Street Journal's got a big article about copper out in the last day or two. And copper price peaked at about 502 cents a pound, US cents a pound. And at the moment, it's sitting around 490 a pound. So it's very close to its all-time high and making great gains. Are we exposed to this copper boom, and in what way? I know Australia is one of the top copper producers in the world. I think we produce about 100,000 tons a year in copper. Some of the big producers, obviously, in South America, Chile and Peru. But what's our exposure through our portfolios?
So it is a little harder in the big end of town to get that direct exposure. Nobles Minerals was the play, and that got taken out by BHP last year. So look, you have to go to the diversifieds, and you will see the benefit flowing through from these higher prices. So BHP and Rio Tinto do certainly have a reasonable exposure, 15 to 20% of their earnings from it, but somewhat dwarfed by iron ore in that sense. We should see BHP continue to expand and increase its exposure there as it looks to build out production capacity. As well, we do quite like some names in the smaller space. A1M we chat about. It's very much has been a small cap, but as these companies prove themselves, it's gone past that 200 million range where we start to think about it for some of our broader portfolios. I have mentioned it briefly in the past, but there's an interesting dynamic going on at the moment with a large Toronto-based copper company called Capstone Copper, which has actually gone about looking to get access to our capital markets via listing their CDIs here. So we are deprived of large copper companies. Here's a large one based in Canada, and they're about $7 billion, which is big for producing assets, moving to 5. And there's about $1 billion worth of free float here in Australia now. So that's a name that we have been doing a lot of work on and have taken some smaller positions as we watch to see how freely those CDIs trade. But yeah, really interesting dynamics going on in the copper market. And if the adage is true, it's Dr. Copper, they're flagging a positive global growth environment, which we certainly believe in.
So is that where you think we are in the business cycle, like at the start of a new kind of re-acceleration? I know it's a big question. No one really knows the answer for sure, but is your sense that perhaps over the next 6 to 12 months, world economic growth is going to start accelerating and drawing commodity prices upward?
Yeah, I think that's what we're seeing in the data. And I think above all, you need to be led by evidence. We can often as investors jump at shadows. And that certainly doesn't lead to long-term strong returns. We look for evidence that we can verify and then invest with. So I guess what we had for the last year was a less worse type environment where the economy was slowing but was holding up better. And then the leading indicators we're following are showing a bit of a bottoming and acceleration in global growth. So Europe is actually leading that. China's improving as well. And the data that we look for are the static numbers around manufacturer surveys, PMIs, but when we're starting to see data come out better than expected, that rate of change is so important for market confidence. I guess on the other side of that, we have our inflation discussion, which is always clouded when the government comes out and posts a stimulatory budget. So
Yeah.
really interesting to see the dynamic.
Well, when we look at the valuations on the market, I mean, we did have our mini correction last month where basically markets went down about 5, 6, 7% across the globe, but they've remade that. And are you still comfortable with where valuations on the ASX are? And are there particular stocks or sectors that you're attracted to at the moment?
Yeah, it's a great question because on the aggregate, you're saying that valuations are fair. We're trading at multiples that are not bottom of the cycle. At the bottom of the GC period, you can see the PE of the market down around 9, 10, 11. We're trading around 15, 16 times, which is reflective of a relatively positive environment. So we don't see the valuations of themselves expanding, but what we're looking for is this earnings growth. But I think it's a time for active management to play its part and for us to look through the index. We've seen a recovery as we've had people move back into the market. So the sectors we were really interested in are some of the beaten up global healthcare names that are trading well with low long-term averages. We're liking some of the other sectors where we're seeing a real positive growth dynamic, which isn't factored into earnings as well around the mining and the services activity there. But core in Australia, our industrials continue to perform pretty well. And we're seeing some strong opportunities there around the names such as, we're looking for some weakness in housing at the moment, but we think there's certainly be some opportunities there to start to buy some housing names.
Well, thank you so much, Will, for joining us this week. Please look out for John Abernethy's more detailed analysis of the budget and what the implications are. I'm hoping that John will have something out in the next few days, and that's always really interesting and worth reading. So I think we'll call it there, Will. Thank you so much. And to the audience out there, we'll see you next week. Thank you.
Bye.